Greetings fellow traders, this is Longshot with part 1 of my tutorial series, where I examine the key question, what is the point of technical analysis? Does it actually work? If you haven't really considered this, now's the time, so let's get to it. There are some who believe technical analysis, or TA for short, is absolutely useless, and among these are highly successful investors, such as Warren Buffett, who in 2005 reportedly said, "I realized that technical analysis didn't work when I turned the chart upside down and didn't get a different answer." I tend to think that he's doing it wrong, but anyway, some of you may immediately think, well, if Buffett said TA is a load of rubbish, then who am I to argue? And you stop watching this video. But if we just take people's word for things, even someone like Buffett, we're not thinking for ourselves, are we? We're just behaving like sheep. We're not learning anything. So let me put a statement attributed to Buffett at the top of the screen. If you don't understand it, don't invest in it. I'll leave it there because it applies to everything I'm going to cover in this video. Now, sure, he was talking about individual companies there, but I think it applies to everything. If you invest in an opinion about technical analysis, for example, but you don't really understand what you're talking about, there's no logic in that, is there? Let's look at Buffett to start off with and understand where he's coming from with his viewpoint. He's what's known as a value investor. He looks for companies with beaten down share prices. He does a ton of research to see if the fundamentals warrant a higher price. He buys and he holds. He doesn't base his decision on charts, but on true company value versus the market's perceived value. He's not alone in this approach. There are several billionaires who've made vast fortunes with this investment strategy. However, that's not the whole story here. Buffett's method isn't just to buy shares and then sit back and wait for the market to prove him right. He has a track record of using his influence to change the management of a company if necessary, also even their business models, to make sure that they turn things around. In addition, as soon as news of Buffett buying a stock becomes public, what do you think will happen? Of course, lots of people will flock in and buy as well, and that makes the share price rise. So Buffett really doesn't need TA at all, does he? It's just not necessary for him. But a small retail investor trying to value invest like Buffett, while ignoring TA as he does, can and will find themselves holding stocks that just keep going down. Why is this? Well, firstly, small investors don't have access to the depth of research that Buffett does. Hence, there's more scope for getting it wrong. And small guys certainly do not have the ability to change company fundamentals and move the markets like he can. Hence, if you're not a big fish with millions to throw at a share and control its fate, it's best to make use of every tool at your disposal to increase the odds in your favour. One of those tools is TA. But what is technical analysis? I actually believe there is many different versions of technical analysis as there are traders. Everyone has a unique approach to reading charts and everyone thinks that they're right. That's fine, but it is odd to lump it all under one heading like that. So what I can do is divide it into two classifications. On the one hand, there's TA, based on mathematical calculations in the form of indicators. And, on the other, there's TA based on pure reading of the price and volume charts alone. Most people would look at such a chart, get confused, and add indicators to try and make it easier to understand. But my approach is not to use any indicators at all. I'll discuss that more later on. But there are people who believe that indicator-driven TA is actually all you need, and that the less you know about the company you're trading, the better. They think knowledge of fundamentals can blind you to what the market's doing, and leave you holding on to loss-making trades for months or years, while insisting that it's the market that's got it wrong. And there's an element of truth to that, but indicator-driven TA can also leave you in a world of pain, which is something that most people neglect to mention. Let me look at some of the giants of indicator-driven TA. And by the way, I mean absolutely no disrespect to any of these people I'm going to discuss here. They all had their own honest ideas for how to trade the markets. What really matters is whether those ideas worked. Let's start with the inventor of the commonly used RSI and ADX indicators, along with others that he invented. His name was J. Wells Wilder. His first book, New Concepts in Technical Trading Systems, introduced those indicators. But he actually published it after he had gone broke following 10 years of trading, and that is hardly a glowing endorsement. He wrote numerous follow-up books, and from what I understand, he did invest in the precious metals boom, which culminated in the meteoric rise that ended in 2011. Not much else is known about him, but he doesn't seem to have a trading record comparable to the fundamental research value investors I mentioned earlier. But his indicators, and similar ones written by other people, are in widespread use to this day. How effective are they really? There are others who are even more highly regarded as geniuses with a rare ability to predict the market. Some of these include Ralph Nelson Elliott, who developed the Elliott wave principle; John Ehlers, who applied fractals and sine wave theories to price movements; and W.D. Gann, who based his methods on astronomy, astrology, the Great Pyramid, numerology, and other arcane topics. I kid you not. All these guys wrote books and have legions of devoted disciples who swear by their methods, but as far as I know, none of them have made absolutely massive fortunes from trading. My firm belief, based on years of experience, not only with shares but also as a currency trader, is that small retail traders need to use and understand both fundamental research and technical analysis. Both FA and TA have roles to play. FA tells you whether a stock is worth buying, whether it's because it's undervalued and about to turn things around, or because it has a compelling growth story that the market hasn't fully factored in. FA should also give you an idea of what the fair value for a company should be in comparison to its peers, and that helps you set profit targets. So if FA tells you to buy a stock, TA then takes over the management of buying the stock. Its role is to help you understand the current market sentiment surrounding that stock, to predict its future price movements and likely turning points, using the past as a guide, and to therefore decide when to enter and at what price, or perhaps to tell you that you need to sit out and wait for the right moment. It's not just about individual stocks though. Researching the fundamentals of a company can be time consuming, but most people can get it done if they apply themselves and they're thorough. But let's look at the whole market. Researching, say, the entire ASX fundamentals, that's much, much harder, beyond most of us. But when there's a change in overall market sentiment, most companies are going to be affected by it to some degree. They're all hostage to the market. It's like a tide pulling stocks either up or down. And you don't want to be caught heavy in stocks and buying more when the tide decides to go out. But FA is useless to you in protecting you from that. The only way to determine if sentiment's changing is through technical analysis. So I classified TA into two groups. There are methods that rely on indicators and methods that focus on reading the raw price data. I'm a firm believer in reading the price directly, and if you've seen any of the charts I post on Twitter, you'll realize that none of them have any indicators, and nor are indicators needed. I've learned over a long period how to read the price like a book through my years of trading currencies, and my methods work equally well with stocks. That's what I'll be teaching in these videos, how you can do that for yourself. In addition, I'll also be looking at how to research a company's fundamentals and how that can help you ignore the hype and opinions surrounding a stock and reach your own judgment. I'll discuss how to enter and manage trades and the ways in which the market will test your psychology and emotions. There's this and plenty of other topics to talk about. This series will take some time to complete. I'll finish by referring you back to Buffett's quote at the top of the screen. I'm sharing the knowledge gained through hard-won experience, not so that I can have any kind of following hanging off me like so many people on Twitter seem to want, but so that people can learn to think for themselves, to back their own judgment with sound reasoning, and to take control of their future as traders without having to be a disciple of me or anyone else. When someone starts from a new trader and reaches that level of mastery, it really makes me happy. If you'd like to move at a faster pace, I do offer paid coaching on weekends, though I already have several students and there's a limit to my time. But if this interests you, please do shoot me an email. In the next video, I'm going to show you why indicators are detracting from your understanding of charts and why they need to be removed before you can make real progress. I look forward to seeing you then.